Now, the dream of home ownership is fast becoming a nightmare in Australia. Property prices in major cities like Sydney and Melbourne are rising fast, putting them out of reach for many. And economists warn the real estate bubble is about to burst. Mobin Nasir reports.
Surf, sand and the famous Opera House. There's plenty to attract people to Sydney. And thanks to record low mortgage rates, tens of thousands are buying property here.
The housing market has benefited from record low interest rates, ready availability of credit, significant inflows from foreign investors, especially from China, who are looking for safe places to park their money, and a tax system that gives quite unusual encouragement to Australian investors to speculate in property markets with borrowed money.
That's driven home prices up by nearly 13% in the past year across Australia, the highest increase in 7 years. But even that jump is low in comparison to Sydney, where houses are now worth 20% more than they were a year ago. There are 5 million people living in Sydney, and the demand for new homes is outstripping supply, widening the housing gap. Last week, the central bank set lower limits on new home loans, but economists say it's not enough, and that when the bubble bursts, many people will be unable to afford their homes.
It would be preferable if the Australian government were to deal with the problem at source by removing some of the incentives that Australia's tax system provides, encouraging geared investment into the Australian property market. But the Australian government so far has found that politically too difficult.
With an imminent housing crisis and the government not moving fast enough to avert it, Australian homeowners may soon face the music. Mobin Nasir, TRT World.
Now, earlier we spoke to Professor Timo Henckel, who's a research fellow at ANU College of Business and Economics. Here's what he had to say about Australia's housing market.
Well, the fundamental problem is twofold. First of all, rising demand with supply that doesn't keep up means that, well, the stock of housing isn't keeping up with the increase in demand, and that's then reflected in higher prices. But the fundamental problem is that the increase in demand is largely underpinned by an ever-increasing debt by the households, and that clearly is not sustainable. At the moment, Australia has among the highest household debt ratios in the world, I think the third largest. The debt servicing ratio is also the third largest in the world, according to the Bank for International Settlements. It's not sustainable. There's going to have to be a day of reckoning when households are going to have to repair their balance sheets, and the whole story is going to unwind, and the house prices will start falling again. The government should have done a lot more in the years gone by. First of all, the central bank, the Reserve Bank of Australia, could have raised interest rates earlier or not reduced them as much as they did recently in anticipation of further increases in house prices. But more importantly, the Australian Prudential Regulatory Authority, APRA, being the main regulatory body for mortgages in Australia, has certain powers. It can request that banks, for example, insist on a minimum amount of equity in the houses, basically, the equivalent of margin requirements, and it's been very slow to the party. We don't know what the government has yet up its sleeve to try to prop up demand for a while longer. So I would, for example, not want to predict when the bubble is actually going to burst. But then we enter a kind of vicious cycle where house prices fall, perhaps unemployment goes up a little bit, there are more and more households who can no longer afford to service their mortgage debt, so they sell up, house prices fall even more, and so on.